Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Wednesday, October 19th. I'm going to go through five charts that I think are pretty important in today's market and the way I'm looking at the market. And given that it's options expiration week, just maybe a little bit different slant for you. Before I get into any of that, though, I do just want to let everyone know if you go over to earningsbeats.com, scroll down, you can sign up for our free Earnings Beats Digest newsletter, which we publish 3 times a week, Mondays, Wednesdays, Fridays. All it takes is a name, email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. We do a lot of free events from time to time. We always make sure we invite all of those on our EB Digest list to those free events. Also, we do have a member event this afternoon where we will be announcing all of the ETFs that will be going into our portfolio for the next 3 months. Every 90 days, we ditch the old portfolio and we start a new one based on current market conditions. That's going to take place later this afternoon at 5:30 p.m. If you'd like to be part of that, all it takes is a free trial. It's a 30-day free trial. This one you will have to give credit cards so we can get you set up. But it is free for 30 days, and we will reach out to you to see if you want to extend after 30 days. So you don't have to worry about just automatic renewal and being charged. Anyhow, that's this afternoon. So again, I want to invite you to join me at 5:30 this afternoon for that. All right. One of the things we're going to be talking about at this model ETF portfolio session this afternoon are the themes taking place in the market. So I think this is a great opportunity to talk about some of the things that we're seeing in the market right now. First up, industrials. Don't know if you've been paying attention to industrials because the market's been going down, but industrials on a relative basis have been very strong. You look at the industrial chart here, and it doesn't really show you that much. This is the absolute price chart. You can see recently, end of September, middle part of October, we took out that June, July low. So we're going to new lows, just like the S&P 500. Doesn't really look that enticing, except look down here at the XLI relative to the S&P 500. We bottomed at the beginning of January 2022. So throughout this entire bear market, industrials have actually been a very strong relative performer. Now, again, not a strong absolute performer going down, but it's been going down a lot less than the S&P 500, and it continues to break out versus the S&P 500. What this tells me is that money is rotating into industrials. If you take a look at some of the areas I've broken down here, there are 5 areas that I put on here. These are 5 industry groups within the industrials where we are seeing strength within the industrial. So the XLI is outperforming the S&P 500, and these 5 industry groups are outperforming the XLI. So these are the best industry groups within a relatively strong sector. So I think it's pretty important to keep this in mind as you're looking at the market to get a better sense maybe of where you might want to have your money parked. So first things first, this DJUSHV, this is the heavy construction index. Look at this relative strength versus industrials. Now, again, we already know industrials relative to the S&P are strong. This is a group strong versus the XLI. So heavy construction, certainly an area to keep an eye on. Next up, defense. Defense stocks have been strong throughout the year, of course, with the invasion of Ukraine by Russia that sparked a lot more interest in defense stocks, which had been languishing for quite a while. That's not been the case in 2022, though. We've got strength there. Waste and disposal services, another area that has been very strong relative to the relative to the XLI. And we know the XLI has been very strong relative to the S&P. Next up, marine transportation, just breaking out again above this double top over here, making new relative highs versus industrials. And then the final one is the commercial vehicles and trucks area, the DJUSHR. Not so strong until July. And now the last 3 months or so, you can see 3.5 months, we've been having a really strong push and a lot of rotation into the commercial vehicles and trucks area within industrials. Haven't broken out to that 52-week high, and through that April, relative high, but we got close. We tested it, pulled back. Now we look like we're starting to turn back up again. Anyway, just wanted to mention industrials very strong on a relative basis, and these are the groups you have to keep an eye on. One other chart I want to show you in the industrial space. This is a seasonality chart. I pulled up the XLI relative to the S&P 500. I want you to look ahead to see what we've got in November. So in October, there's a little bit of relative strength versus the S&P 500 historically, going back the last 13 years, which takes us back to the bottom in 2009. October has been better than, or we've seen the XLI outperform the S&P 500 in a little bit more than half of the Octobers. And you can see the average relative outperformance down here, 0.4%. That's decent. So October is a good month, but look at November. Of the last 13 years, industrials have outperformed the S&P 500 12 of the 13 years, and we've outperformed to the tune of 1.7%. That's over and above what we average on the S&P 500. Very, very strong historical month upcoming for industrials. I think that's really important to keep in mind. Next up, I think there's probably nothing more important in this market right now than the 10-year Treasury yield. Watching it as it's been going up, you can see back in March, April, May, June, when we really made a big push to the upside, we went from 170 up to 350. So the yield, 10-year Treasury yield, doubled in just a little bit more than 3 months. Look at the NDX dropping, and I want you to look at what that impact has had on growth versus value. The IWF IWD is a growth value ratio. It's in the large cap arena. So we're talking large cap growth versus large cap value. This index took a hit all the way until May. Now, as we saw the 10-year Treasury yield actually pull back in a channel here for about probably until about the middle part of August. That's when we kind of broke out of this channel. So from mid-June to mid-August, remember, that's when we had the big run in the S&P 500. It was because rates were starting to roll back over again. Now, the NASDAQ, you can see during those 2 months, big push to the upside. The IWF versus IWD, big rally. So growth was being favored over value. But now, after breaking out of that channel and making another run to the upside, look at the NASDAQ breaking to a new low. The IWF IWD has been falling, but we have not gotten back down to that May low. I think that's a pretty good sign. And so what I'm looking for is for the 10-year Treasury yield to reverse. If we could get a big reversal here and start to trend lower, we have a negative divergence, by the way, that could trigger a move down in the 10-year Treasury yield here at some point. So I'm watching for that because there's a lot of history here in 2022. If yields start to pull back, expect a rally in the NASDAQ and in growth versus value. All right, next up, it is option expiration week. And here's a 5-day chart. You can see the S&P 500 moving higher. There's been a lot of movement to the downside in the past several weeks. And as a result, there's a lot of net in the money put premium. And so it would behoove market makers to kind of push prices higher. And we're seeing that a little bit at the open. We saw that back on Monday, where we gapped up, traded up in the morning, and then kind of went sideways. We gapped up again on Tuesday. I think there's a little manipulation going on. This is wiping out a lot of net in the money put premium. Today, we're actually pulling back a little bit, but with yields moving up, I'm surprised we're not down further. And probably the reason we're not is because it is option expiration week. But over these last couple of days, I wanted to just point out a couple of things. Autos, which have been horrible. Notice this week, we made a big push on Monday, and even through today, we're holding up. We're actually showing relative strength in autos today with yields rising. It makes no sense, except it's option expiration week. Look at the semiconductors. Semiconductors have been going down, down, down relative to the S&P 500. Even on Monday, struggled a little bit. Tuesday morning, we went down, but now we seem to be gathering ourselves here and starting to trend higher. There's a lot of net in the money puts on semiconductors. Don't be surprised to see some additional outperformance on a relative basis heading into Friday to potentially lower some of that net in the money put premium. I call this week opposite George week. If you're a Seinfeld fan, you'll know what that reference is. But basically, when you go into option expiration week, things that have been working tend to not work as well. And things that haven't been working all of a sudden come to life. It truly is like opposite George week in the market. The final chart I wanted to show you today, this is the 10-year Treasury yield versus the 2-year Treasury yield. So when we look at this yield spread or the yield curve that is mentioned a lot, you can see right here, this is the zero line. So anytime the 10-year Treasury yield goes below the 2-year Treasury yield, that's normally not a good thing for financials and can lead to a recession. When banks have to start paying out in terms of the short-term rates, that's really is tied more to their liability side. And so when the short-term rates are going up, they have to pay out more. And when we get this flip and the yield spread goes negative, the yield curve's negative, we have to realize that this could be bad for banks. One thing I want to mention, though, I audited banks when I was in public accounting. I think a much better measure is the 10-year Treasury yield versus the 1-month Treasury yield. I think that this is much more indicative of what truly goes on in the financials. And if you look at both of these charts and pull up the correlation indicator and just test the correlation of these two spreads versus the XLF financials relative to the S&P 500, you'll actually see that this is a much tighter and stronger correlation, the 10-year Treasury yield minus the 1 month. And notice we haven't gone negative on this one yet. 10-year minus the 2-year, we've been negative now for a few months, really since back in July. But the 10-year minus the 1 month, not so much. And we bottomed the beginning of August. We started moving back up as the market was starting to do a little bit better. And even with the stock market moving down, even with the Fed continuing to hike rates, we have not broken back down on this spread between the 10-year and the 1 month. So I think that's a really important thing to keep an eye on as we go forward. I think if this bottom here at the beginning of August holds, I think it's less likely that we'll see significant deterioration in the financials. And if you're thinking recession, financials are an area that will tell us. And right now, they're really not giving us that signal. If it is a recession, I think it'll be a mild one based on the way the financials have been trading. Anyhow, that's all for me. I appreciate you tuning in today. As always, I love coming on here and doing these your daily fives. It's a pleasure always to be here with you. Just remember, this afternoon, we are going to have the model ETF portfolio draft over at earningsbeats.com. I'd love to have you join us. So if you go over to earningsbeats.com, you can sign up here for a no-cost trial. We'd love to have you this afternoon. Otherwise, just make sure you scroll down and sign up for our Earnings Beats Digest newsletter 3 times a week, Mondays, Wednesdays, Fridays. It's 2 paragraphs and a chart. Very simple, easy read, and we'd love to have you. Listen, everybody have a great day. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.